China's economy is slowing, not collapsing, not breaking, just slowing. And that distinction matters more than most investors realize. Because when China slows gradually, global markets don't react loudly, they react late. In this video, I will explain why China's slowdown matter far more than headlines suggest and why global markets, including India, may be underestimating its impact. So most investors think only two things matter. Either China is booming or China is crashing. But markets rarely get such clean signals. A slow, prolonged deacceleration creates something worse than panic, uncertainty. And markets struggle far more with uncertainty than with a bad news. That is exactly why China's current phase feels uncomfortable. China is deeply embedded in the global economy. It influences the commodity demand, manufacturing supply chains, and global trade momentum. So when China grows slower than expected, demand softens quietly, pricing power weakens, and global confidence erodes gradually. Markets don't reprice this overnight, they misjudge it first. That is why slowdowns are often underestimated early. A sharp shock creates clarity, a gradual slowdown creates doubt. Investors start asking, will the stimulus work? Will the growth accelerate again? Or will stagnation persist? When those answers are not clear, markets become defensive, not bearish, defensive. That shift shows up as lower conviction rallies, selective risk taking, hesitation across asset classes. This is exactly the environment global markets are in right now. When uncertainty rises around China, global capital becomes selective. Risk appetite shrinks, and when that happens, emerging markets feel the pressure before the developed ones. Even strong economies are not immune, not because they are weak, but because global money becomes cautious everywhere. This is about risk management, not panic. The biggest mistake investors make during China's slowdown is waiting for dramatic headlines. But by the time headlines turn loud, markets have already adjusted, positioning has already shifted, opportunities have already changed. China risk does not announce itself clearly, it seeps into the market gradually. Ignoring that process is to delayed reaction. China is not a trading signal, it is a context signal. It will help you understand why the rallies lack conviction, why risk appetite stays selective, why markets feel hesitant despite an okay data. You don't react emotionally to China, you just adjust your expectation. That is the difference between reacting late and staying prepared. If you want market explanations that focus on context, not noise, subscribe to this channel because when China slows quietly, markets explain the impact only after it is already felt. Thank you.